is Russ Squire, and I'm the president of 1031 Property Exchange. And over the next short while, I'm going to take you through a course on using 1031 exchanges to grow your real estate wealth. So, these are our offices. Offices are located on Stone Ridge Drive in Bozeman, and then there's a list there with our phone number, our website address, also our email. A little bit about my background. I was a 1982 graduate of Montana State University in Finance and Economics. I worked for Bank One of Ohio. Also worked as an investment advisor, licensed investment advisor. 2004, I founded a company called Big Sky Property Exchange, and it was the only intermediary in Montana that was licensed in real estate and securities. We've also helped capitalize quite a few development projects. I was very involved in the local community. So anyway, to make a long story short, there is my background. So what is a 1031 exchange? Well, a 1031 exchange is a provision in the Internal Revenue Code. And what it does is it allows the owners of property that's held for business or investment purposes to roll all their equity from their existing property into another property without paying capital gains tax, any depreciation recapture, and state capital gains taxes. Kind of think of it like an IRA rollover. It's like a suitcase. It's portable. You can port the gain between properties. Who exchanges property? Over 65% of all 1031 exchanges are for 1 to 4 unit rental properties, and the other 35% are commercial and ranch. Now, the commercial and ranch real estate represent over 50% of the value of all the exchanges that are completed. However, that's just because of their relative size of those transactions. Here's an exchange diagram. You can see in the upper left-hand corner, there's an exchange or sale of relinquished property. From the exchanger goes a deed down to the buyer on the left-hand side. Across comes money to 1031 Property Exchange. We don't ever see the money. The money actually is wired directly from the closing company to the escrow bank. Then the money flows from the escrow bank out to a seller, who in turn directly deeds to an exchanger. Now you can do direct deeding with 1031s, and we do direct deeding all the time. So down at the very bottom you can see the exchange period. There's 180 days total. The first 45 days are what is called the identification period, and that's where you identify your replacement property, and then 180 days is the total period to complete the exchange. Now the money and instructions flow in a 1031. You'll see 1031 Property Exchange down there at the bottom. We send out instructions to the closing or title company. They send back settlement statements. We approve them, send them back. Then when the closing occurs, you can see the cash flowing at the top up to the escrow bank. There can also be cash flowing to the exchanger, but in that case there's some taxable boot that's been created, and the exchanger will likely have to pay tax on any distribution that comes from the exchange. We also receive instructions from the exchanger. Those instructions primarily are when to transfer money, and we require signatures to transfer money. We also send instructions over to the closing or title company for the replacement property. And then finally we go to the escrow bank and wire the funding in for closing. So that's a general flow of money and instructions that occur during an exchange. What is a 1034 exemption? Well, a 1034 is for primary residence and allows you up to $250,000 in gain to be taken out tax-free for a single taxpayer, and $500,000 in gain for a married couple filing a joint return. The biggest mistake most people make regarding a 1034, they confuse the $250,000 or $500,000 in gain with the gross selling price of the property. And that's not the case at all. You can sell a $2 million home as a married couple, and as long as your cost basis is not below $1.5 million, all the gain is exempt from taxation. The 1034 exemption has a 2-year holding requirement. You can sell a home every 2 years. It's a popular trick amongst home builders. They'll build a home, move into it, live in it for 2 years, sell it, then start over again. And I know a lot of builders do it. Within 4 or 5 homes have paid for their own home that way. What if the gain is greater than the 1034 exemption? What can you do then? Well, here's a tax tip. Consider converting part of the primary residence into a rental property, and then using a 1034 rollover combined with a 1031 exchange. 5 basic rules for 1031 exchanges. Well, 1, both the relinquished property and the acquired property must be held for productive use in business, trade, or for investment purposes. 2, the proceeds must be exchanged through a qualified intermediary. 3, a qualified escrow account must be used to hold the relinquished property proceeds unless the exchange is a simultaneous exchange, meaning the property being sold and the property being purchased are both done on the same day. We don't see that very often. Usually most exchangers go for what we call a delayed exchange. All cash proceeds from relinquished property have to be reinvested in the replacement property, or you're going to be creating what's called taxable boot. We'll talk more about that later. And then the replacement property must be subject to an equal or greater level of debt than the replacement property, or the exchanger will have to pay taxes on debt reduction or put up cash to offset the lower debt level in the replacement property. Now, the wealth machine that 1031 is, think of the acronym TLC, taxes, leverage, and compounding. The power to defer taxes. You just keep deferring throughout your lifetime from investment property to investment property. Defer, 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 die. Why? Because at death, you receive a step up in cost basis to the date of death or 6 months following the date of death. The power of leverage is the dollars saved in a 1031 is extremely powerful because those dollars can continue to compound and multiply. And then finally, increasing your cash flow, converting non-income producing property like raw land into income producing property. And you get to buy better property and get rid of management responsibilities. So there are a lot of reasons to do 1031, but 1031 exchange really is a wealth creating machine of a tool. The power to defer taxes. Let's talk a little bit about that for a second. Deferring capital gains taxes on income and investment property allows for a step up in cost basis at date of death to your heirs. That eliminates the taxes owed, making all that deferral into a tax-free transfer. Now, estate taxes are a separate issue, and they're caused by the overall size of your estate. And there are ways to avoid these by planning using trusts, high exemptions, and other sophisticated estate planning tools. Taxes on the sale of real estate will increase your adjusted gross income. And what that means is you can lose your itemized deductions, medical deductions, IRA deductions, child care deductions if your AGI is too high. And 1031 can solve these problems. Large increases in your adjusted gross income can also cause taxpayer exchanger to get pushed into the alternative minimum tax bracket, which is significantly higher than the regular tax bracket and much higher than capital gains tax rate. So the power of leverage and compounding. A $100,000 tax savings on an $800,000 property sale means you can buy another $500,000 in real estate at a 20% loan to value ratio. So with a 1031, let's say you sell an $800,000 property and you pay no taxes. You had a $300,000 note, you buy a new property, you increase the note to $700,000. Your equity from the original exchange is $500,000 on a $1.3 million property. So at 6% compounding, that turns into $4.16 million over 20 years. So without a 1031, you sell the property and pay the $100,000 in capital gains, depreciation, recapture, state income, and that leaves you with $700,000. So you've got the same $300,000 in debt that you used before, and you go out and buy a replacement property. You add your initial equity, which is now $400,000 because you lost $100K to taxes, and then that allows you to purchase $700,000 property. At 6% compounding, that turns into $2.24 million over 20 years. So not doing an exchange cost you almost $1.9 million of wealth building potential over 20 years. And as our friend at the bottom here, Albert Einstein, said, compounding is the 8th wonder of the world. Increase your cash flow. Raw land doesn't cash flow. It can't be depreciated. So there are no income or tax benefits. The only benefit is appreciation. Convert raw land via 1031 exchange into triple net lease and or multifamily rentals. You'll gain from positive cash flow, depreciation allowance will help reduce your taxable income, and you have appreciation potential. Buy better property management headaches. Investors with older rental properties that will have a large future maintenance expenditure can use a 1031 to buy newer property that will require less maintenance. Older properties with reduced debt levels normally have higher cash flows, but as their depreciation allowance grows smaller, they begin producing what's called phantom income, and that creates tax. Hiring a property manager can alleviate a lot of tenants, toilets, and trash headaches for you while you're still maintaining a positive cash flow. And triple net lease commercial property is without a doubt the undisputed king of solving real estate management headaches. 1031 exchange super tips. I'm going to walk through some tips with you that are going to be valuable. So first, using the lease option to avoid dealer status that forces full-time developers to pay ordinary income tax on gains. I call that the part-time developer strategy. Number two, buying a vacation home in paradise tax-free using 1031 and or 1034 exchanges. I call that the paradise strategy. Number three, take cash out tax-free from your 1031 exchange. Now I know you've heard that you can't take cash out of your exchange, but there are some ways to do it, and we'll show you that strategy. Number four, building your dream home using 1031 exchange and 1034 rollover. I call that the dream home strategy. Buying your kids a home tax-free, renting it to them at 20% below market rents and converting it later to a personal residence. I call that the sweetheart strategy. Number six, how to save big bucks turning a build-to-suit exchange into a delayed exchange. I call that the home builder strategy. And number seven, the conservation buyer strategy. That's when you combine a 1031 exchange with a conservation easement to get into a property for a very, very good cost basis. That's the ranch buyer strategy. But all of these tips are pure gold for real estate investors. Tax-free cash out from the exchange. Let's go over that first. Two ways to do it. First, refinance the relinquished property or the one that you're selling before the exchange and take out cash. Then you roll all the remaining net selling price into the replacement property and you didn't pay any tax on the money you took out. You can also refinance the replacement property, the one that you're going to buy, the second property after you've sold. And when the 1031 exchange is completed, you take out cash by refinancing that property and you still don't have to pay taxes. Now warning, taking cash out during the exchange does create a taxable event. But these techniques are legal techniques that give you protection for the exchange under IRS Safe Harbor rules. Buying a vacation home in paradise tax-free. Use a 1031 rollover to buy a unique vacation property or dream home. You can attempt to rent it or place the home with a property manager. Use it no more than 2 weeks per year for the first 2 years. You can add additional time for marketing and maintenance visits up to 2 weeks, so you can bring the total use really up to about 4 weeks. But you want to get a letter from your realtor, or that can at least help document these visits for marketing and maintenance. Now be careful because the IRS does audit utility records in making sure this is not abused. Also file 2 Schedule E and 2 4562 attachments on the property with your tax return. And then convert the property in the second year, after a 2-year holding period, to your personal residence tax-free. You can then bring in the equity on your primary residence using a primary residence exemption, or the 1034 that we discussed earlier, bringing the dream home debt to zero, and then you convert the dream home in paradise to your primary residence. Using the lease option to avoid dealer status. Now there was a Supreme Court case in 1966 called William Mallet versus Riddle. And here the Supreme Court said that to be a dealer, your first purpose, your chief, principal, primary, and only purpose must be to sell. Now by using a lease option, properly structuring a lease option, you can avoid dealer status, and they're the single best way to avoid dealer status in a selling situation. And avoiding dealer status allows the seller to do a 1031 exchange. Now the option agreement should make reference to the lease, but the lease should not make reference to the option agreement. And the lease should be for at least 2 years, so that gives you that 2-year holding period once again. And then at the conclusion, lease options help developers who do not develop as a primary form of business sell developed property and avoid dealer status. The downside is, the 1 to 2 year holding period, but do not pay the taxes. It's a small price to pay. Okay, so sweetheart strategy for aging parents. Buy a second home with a 1031 rollover near your children and grandchildren. Rent it to one of your children for up to 20% below market rents. The IRS says that's completely legal. Grandma and grandpa can even gift up to $14,000 per year per child, grandchild, daughter-in-law, son-in-law, and then they can use that as they see fit, to pay, say, for instance, the rent or the mortgage, thereby allowing them to save up a nice down payment for a home of their own. Grandma and grandpa can visit or live in the property. How many days per year? Well, as many as they want. Who's keeping score? It's primary residence and it's a rental property. So, as long as the people who are occupying it, and I'm assuming your in-laws would let you stay there, then you can stay as much as you like. Now, you convert the property after 2 years of renting it to the kids into a personal residence tax-free. And then, if grandma and grandpa decide to make the property a personal residence, they could also sell their previous primary residence and use a 1034 rollover to reduce the debt on the new residence to zero. Combining 1031 exchange with a 1034 rollover to construct a move-up home. Say, you own a home with 100% equity, and you have a rental property where you've got about 50% equity. First year, sell the rental property and use a 1031 exchange to acquire raw land for the dream home. In year 2, do some base improvements like road, electric, gas, and sanitary. Finally, in year 3, on the second anniversary of the rental property sale, begin construction of the dream home and convert the land to personal use, tax-free. Then you can list the primary residence using a 1034 exemption, and you can pay off the construction loan for the new primary residence, which is going to be the move-up home. So there are ways to accomplish all of this as long as you stay within the guise of what is, pronounced as legal by the IRS. Builder's delight. Taking expensive build-to-suit exchanges and making it into a delayed exchange and saving money. A builder is attempting to complete an IRC 1031 exchange, having sold a rental property, and is now trying to construct a new rental home on raw land with a 180-day total exchange period. Now, the builder has nightmares over doing another build-to-suit exchange because they've done this before, and their exchange intermediary the first time was slow dispersing funds to satisfy their vendors. Plus, the exchange cost the builder $6,000 because build-to-suit exchanges are expensive. There's a lot to account for. So, what's the solution here? Well, basically, a builder can refinance the property they're selling prior to its sale and take out the equity necessary to complete the improvements on the property they are building, tax-free. Builder then controls all the money necessary to complete the improvements instead of the qualified intermediary, so he's got no vendor issues. Builder then completes the new structure within the 180-day exchange period. And the builder saves themselves about $5,000 in exchange fees because the delayed exchange is relatively inexpensive. Constant strategy, as land costs create a lack of economy for traditional farm and ranch uses, large ranch buyers have become the economic elite, often with substantially different objectives from the mainstream ranch establishment. Conservation buyers are often interested in conservation, fish, game, preserve management, or enhancement, and pure solitude with no intention of ever developing the property. So by combining a 1031 exchange with the tax benefits of a conservation easement, the buyer can get into the property for very little money out of pocket and a very, low cost basis. Now, conservation easements do take a while to set up, so you want to be aware of that, but for the most part, they can be set up after the property's been acquired. That's not an issue. You're going to receive the benefit either way. So understanding the investment property decision. When you're reinvesting in an exchange, just always remember, higher returns means higher risk. Diversification by the type of property owned and region of the country that it's owned is important. National tenants with a strong credit history, great location, and long-term lease make the best tenants. And don't get tempted into stretching for yield or concentrating too many assets in any one property type or region. These are avoidable mistakes. What types of property can you invest in? Pretty much the sky's the limit. Shopping centers, multifamily apartment complexes, single-family homes if you rent it, big box commercial stores, strip malls, even fast food franchises, industrial property, office buildings, retail stores, storage facilities. So that really pretty much any real estate to any real estate as long as it's held for business or investment purposes. Where are you going to invest? Well, you've got to look at what markets are the best. what property types are the best, and what are the risks associated, especially when it gets down to financing. I mean, you always want to make sure your financing terms are matched up to your expected holding period for a property, so you don't hold any interest rate risk in the chance that interest rates rise in the future, you're going to have to refinance at much higher rates. That's an avoidable mistake. 12 exchange rules and their topics. You have to use a qualified intermediary. You have to use a qualified escrow account. You have to meet the like-kind requirement. The language needed in the buy-sell agreement has to be right. You have to have proper documentation. You have to meet the holding requirement. You have ownership and registration rules to comply with. 1031 time requirements. Property identification rules in an exchange. You need to know what constitutes boot in an exchange. You need to know the total exchange period, and you need to know how to select a qualified intermediary. So let's go over each of these briefly. You must use a qualified intermediary. What does qualified mean? It means an independent, unrelated party in all delayed and simultaneous exchange transactions. Now, the qualified intermediary is a middleman in a safe harbor in the IRS regulations. Now, there are two types of QIs or qualified intermediaries. A limited service, which just does documents and acts as an escrow but will not advise on the technical aspects of an exchange. And then there's a full service, which does full-time exchanges, acts as an escrow, completes the necessary documents, and does advise you on the technical aspects of your exchange. Now, 1031 Property Exchange, my company, is a full-service qualified intermediary. Who can't be your qualified intermediary? Well, your accountant, attorney, financial advisor, realtor, or any relative. Now, you must use a qualified escrow account. Now, with the exception of simultaneous exchanges, all other exchanges require a qualified escrow account. And this is a safe harbor under the IRS regulations. Now, the exchanger must not have the ability to receive any exchange dollars during their exchange, or it's considered constructive receipt, and that means taxable. The escrow account cannot be pledged as security or collateral during the exchange. And the exchange company should have clear written policies that require the exchanger's approval of every escrow dispersal. And that's really important. The qualified intermediary and the qualified escrow do operate as separate IRS safe harbors. The qualified intermediary completes the documents that keep the transaction in compliance with IRC 1031, and the qualified escrow holds the funds during the exchange period and complies with IRC escrow requirements, like no constructive receipt, as we discussed earlier. Now, intermediaries can and often will perform both functions, and we do that. We act as the intermediary, and we also set up the escrows. It's just a convenience for our customers. The like-kind property requirement, it's pretty broad. Basically, it means any real property for any other real property, as long as they're held for business or investment purposes. All the properties you see below are like-kind. So you can sell a condominium and go into a ranch. You can sell an apartment and go into a townhome. You can sell an office and buy a single-family home. The sky's really the limit. There's even more to like-kind property. A ground lease is like-kind. A lease of 30 years or more, like you'll see with many Forest Service leases, for instance. A partial tenant and common interest in real estate, as long as it's a divided, deeded interest. Easements are also exchangeable. Mineral and water rights, gold, silver, artwork, improvements to be constructed, also exchangeable and are considered like-kind property. And then certain timeshares. So what's not like-kind real estate? Inventory or property held primarily for sale, as we discussed earlier. Corporate stock, bonds, securities, real estate investment trusts, mortgages or notes. Those are considered, securities. A partnership interest, certificates of trust or beneficial interests, real property for personal property. In other words, you can't go out and sell a piece of real estate and then turn around and buy a car with it. Exchanges between certain related parties under IRC 267, where one of the exchange properties is subsequently transferred before the end of 2 years. And there we get back to that 2-year holding period again. Certain intangible assets like going concern value and goodwill will not qualify for an exchange. And then real property in the U.S. for real property outside the U.S. You can't exchange into foreign property. Now, special rules for partnerships. A partnership interest does not qualify for an IRC 1031 exchange. Now, that's the interest. However, an entity, the partnership itself, can qualify for a 1031 exchange provided all the requirements are met, and including the same partnership entity, meaning the same partners. So have to continue to hold the replacement property. So you've got to get all the partners to agree on that. Language you have to have in the buy-sell to allow an exchange. Well, there it is right there. I won't read it to you and bore you, but just seller herein acknowledges that it's the intention of the buyer to complete an IRC 1031 exchange and so on. So we've got copies of the language on our website. You're more than welcome to go to www.1031property.exchange and just cut and paste the language if you need it, but most realtors are pretty familiar with it. Language you should avoid in a buy-sell. Now, we've seen these mistakes made a bunch before. Don't list any significant personal property in the buy-sell on settlement sheets. You could do a parallel rollover of real property for real property and personal property for personal property to create a non-taxable event, or just acquire the personal property separate from the real property exchange with funds outside the exchange or outside of closing. These are true stories. I mean, I've seen realtors list garbage disposals, washers, dryers, stoves, and even the kitchen sink when they know they're doing a 1031 exchange. It makes things messy, especially with many of the items that get listed because they're fixtures and you know, they have to be assigned a market value. Proper exchange documentation. You have to have a 1031 exchange agreement, a 1031 exchange escrow agreement, a 1031 exchange addendum and assignment, 45-day identification letter, the 1031 exchange settlement sheet. We'll go over each of these. You also have to have an affidavit of disclosure of non-foreign status, 1031 exchange settlement sheet for the replacement property. That means the one you're going to be buying. And then also the Patriot Act requires a copy of the exchanger's driver's license be submitted with every exchange. Proper escrow procedures. Only use an intermediary as an escrow agent if they meet the following 3 requirements. And this is for your safety. They use a federally insured bank. They have procedures that require written escrow authorization forms signed by the client, and their escrow bank requires this form in writing prior to releasing any funds. And then finally, they perform all funds transfer by direct wire or deposit and from the closing title company. So, you know, both to and from. So that way there really isn't any chance of any kind of misappropriation of funds. The holding requirement. The relinquished and replacement properties must be held for investment or business use. You must use the property for your business as rental property or as an investment, like land. You must not use the properties for personal use with the exception of the 2 weeks a year and then 2 weeks for marketing and maintenance visits. There's also a 10% exception under IRC 280A. You must not hold property as inventory for immediate sale to your customers. You should not hold back or hold the properties primarily for sale with a pre-intent to sell. According to the IRS, you must hold the replacement property for a period of at least 1 to 2 years. 2 is better. In fact, we really recommend 2 anymore because it's just possible you could get audited. And then according to the IRS, there should be a consistency of ownership from the relinquished property to the replacement property without any changes for a 1 to 2 year period. Some more rules with respect to holding. According to the IRS, there should be a consistency of ownership from relinquished property to replacement property without any changes for a 1 to 2 year period. This means don't change ownership composition or the way in which the property is held at all within the first 2 years. This means placing the property in a trust or buying interests of another tenant in common or any conceivable form of registration change. About the only exceptions would be death or divorce. I mean, the IRS is going to understand that that necessitated an ownership change. 1031 time requirements, 45-day identification rule. There are no free hall passes on this one, and there are no exceptions to this rule for weekends and holidays. So you got to pay close attention to where your 45th day falls when you're doing an exchange. The 180 day total exchange period, that's the total time from the beginning date from the sale of the first property, and really not much exception to that rule. Both these time requirements have to be met to have a qualifying 1031 exchange, and the time periods run concurrently. They both begin on the date of the sale of the first property. Can you get outside the safe harbor on an exchange? Well, the 45-day identification rule has no exceptions. The 180-day total exchange period has no exceptions, but reverse exchanges do often extend beyond the 180-day total exchange period. If the IRS does an audit on the exchange, or even if they, if they do audit it, it might be allowed to stand, but they could disallow it. So that's the risk of going outside the safe harbor rules. Property identification rules. You can identify property. Now, 90% of all the exchanges we see use the 3 property rule. And basically what that allows you to do is you can identify any 3 properties regardless of their value, but you must acquire at least one of those properties as your replacement property. And that's used by 90% of all exchanges. And I'll tell you, when you're identifying property, that's the time to sit down and write the buy-sell. You don't want to be writing the buy-sell sometime between the 45th and 180th day only to find that your property has disappeared on you. The 200% value rule, you can identify more than 3 properties, but they can't exceed 200% of the selling price of your relinquished property. And then there's the 95% rule. Not sure I've ever seen it used, but you can identify any number of replacement properties if the fair market value of those properties actually received by the end of the exchange period is at least 95% of the aggregate fair market value of all potential replacement properties identified. Now, what constitutes boot in exchange? Boot is taxable income created in a 1031, and it can be created in several ways. 1, not reinvesting all the sale proceeds of your relinquished property. 2, taking cash out during the exchange. 3, personal property listed on the buy-sell agreement. And 4, you reduce the total amount of mortgage note. In other words, if you've got $100,000 on the property you sold, you got to have at least $100,000 on the property that you're buying if you don't want to have some level of taxability created in the exchange. So the total exchange period, 180 days, no ifs, ands, or buts to complete your exchange within the IRS Safe Harbor. Otherwise, you're in an unsafe harbor, and the IRS might start shooting at you, so as in an audit. The first 45 days of the total exchange period are the identification period, and these 2 periods, as I said before, run concurrently. So how to select a qualified intermediary? Well, you want to make sure they have experience in complex tax planning and estate planning. They have the technology to electronically deliver documents. They have a website you can use as an educational tool and a resource, like we do at 1031 Property Exchange. They give exchange advice plus prepare documents. And they have procedures that stipulate in writing that the exchanger must approve all disbursements. Also that they only perform exchanges. I can't tell you how many exchange companies out there also practice law and do tax preparation. You want somebody that's a true specialist. So why should you give your 1031 exchange business to us at 1031 Property Exchange? Well, we use the safest procedures, making sure clients sign for all disbursements and that the funds are wired directly from closing to escrow. We deliver all documents electronically and offer the best training, education, and resource tools for clients, and we can deliver duplicates to your attorney, CPA, and your realtor. We're experienced and have performed hundreds of exchanges. We maintain offices convenient to many major title companies, CPAs, attorneys, and next door to our bank, which helps expedite transfers. And we have 24 years of estate planning experience and have helped clients perform hundreds of 1035, 1031 exchanges, conservation easements. And combining these strategies can allow many of our clients to purchase better property with no money out of pocket. So what other services can we perform? We independently assist clients looking for triple net lease property through local and national network of commercial realtors. We perform due diligence services. We've done due diligence on large projects. Introduce clients to attorneys that can form a tenant in common agreement. Our decades of estate planning experience have helped us develop relationships with the state's best attorneys. We can introduce clients to banks with favorable lending terms. We can also introduce clients to trustees and institutional property managers that can handle triple net lease commercial properties. So that's about the end of it. If you'd like to call us for a free consultation, our phone number is listed right here, area code 406-425-2742, or visit our website at www.1031property.exchange. And you're also welcome to email me. This is Russ Squire for 1031 Property Exchange, and thanks for your attention.